When you look at the 10-year, I mean, that yield has been coming down along with all the trade tensions as well. Where we stand now, are we more likely to go to 2.5 than we are to 3?
Well, you see, I mean, I think that the hard thing with this trade policy, and we were talking about it earlier, is that it's very unclear what the administration's actual position is. Now, whether this is a negotiating tactic to try and solicit more, concessions out of China or whatever, we don't really know. And so the market is naturally, uncertainty obviously leads to concern. Concern leads to kind of risk-free rates doing better. And I think that's what we've seen. So there's nothing in the U.S. in the fundamentals that is shifting. There's nothing in the policy projections. The Fed themselves have said that, that obviously trade is really important to the U.S., but they don't know what the policy is going to be. So it's very hard to adjust your expectations without knowing. I think it's very much a function, honestly, of concerns and uncertainty. And if those pass, which is our base case scenario, I think Treasury yields continue to rise. So I think it's more likely that we see 3% before 2.5%.
Okay, so you still think there's room to go higher, despite the lid perhaps being put on for now because of the trade tensions. Room to go higher. Neil Kashkari of the Fed, of course, has been talking about where he thinks the neutral rate is and what happens next after we get to the neutral rate for rates at the Fed. He says maybe the Fed is confused. I've got this chart here, talks about unemployment being below every Fed official's estimate of the natural rate of unemployment. How much hiking do you think we still see then from the Fed as with these unemployment levels persisting?
Well, I mean, I think first of all, the facts are that the Fed dots are much higher than the market predictions in terms of the terminal rate, right? So you have, 50 to 75 basis point spread between where the market assumes the terminal rate to be and the Fed assumes the terminal rate to be. But I think that for us, the near-term investment implication is that the Fed is on, not on autopilot, but the bar for changing their policy, I think, is extremely high right now. They need to get the policy more to neutral, then assess the economic situation, assess the inflation situation, in fact, the wage inflation situation. And so I think it's a little premature to debate whether we're going to go past what we've already baked in for the next 2 years. I think what we need to see is how the economy develops and how those rate hikes impact the inflation trajectory. So in other words, we can debate what the terminal rate should be. I think that's important, and it seems like it should be slightly higher than what than the market is currently pricing. That being said, over the next year and a half, I think the Fed is really going to be on autopilot.